Goldman Sachs is out with a new call expecting the Federal Reserve to start cutting rates sometime in the second quarter of next year after one final hike in November. Joining us now to talk more about that, former Dallas Fed President Robert Kaplan. It's kind of perfect because you're both a former Fed guy and a former Goldman guy. Welcome. Good morning.
Good to be with you, Kelly.
So the cutting is not, we haven't talked a lot about it, but it's already priced into the market, really. We had those comments from John Williams a couple weeks ago to the New York Times where he said, we might have to cut so that we don't end up passively tightening. So talk to me a little bit about the path you think is most likely, especially since we were just talking about, long-term bond yields and worries about which direction they're going to go, that sort of thing.
Well, there's no question to me that inflation is softening, but you have a number of cross currents, as you and I have talked about before. Goods are very weak. China being so weak makes goods disinflation even more pronounced. On the other hand, you've got substantial amounts of project-based government spending. The service sector continues to be resilient, and inflation is sticky there. And you also have oil prices, inching up. And so we've got a number of cross currents to get through. I don't think the Fed will take any action in the September meeting, but I think an estimate that by middle of next year, they'll feel that it's appropriate to cut rates isn't unreasonable. I don't know if it'll turn out that way, but that's as good as expectation as any, I think, at this point.
Are you worried about headline inflation picking up again on the back of oil prices or just labor market or whatnot?
If it were not for the government spending that we're executing right now, I would not be terribly worried about that, and I would think that inflation would continue to trend down. But we continue to announce new multi-billion-dollar manufacturing plant projects, public-private partnerships, infrastructure projects, unspent ARPA money, and that's the X factor that's hard for me to gauge. And that's the reason why I think if I were at the Fed, I'd be on my toes to see how these cross currents are going to unfold. But I think you've got enough weakness and weakening in the U.S. economy that I'd still be hopeful that we're continuing to make progress on inflation.
Yeah. I mean, sort of kind of put that differently, we have one hand fighting against the other. So we have a lot of fiscal stimulus still hitting the economy at the same time the Fed's trying to tighten. Is it all going to be Goldilocks and work out just fine?
Well, so this is where I think the attention is going to shift. It's all been at the Fed funds rate and the front end of the curve. You can see in the markets, attention is now shifting to the back end of the curve, the 5-year, the 10-year, the 30-year. And there's a price for this amount of government debt to GDP, historic deficits, expected historic deficits, current fiscal spending, and that is the 10-year is backing up. And I think the story may be over the next 6 months, the backup in the longer end of the curve, that is further tightening. It hurts business, makes the bank situation a little more difficult to the extent they own long-term assets. So there's a price to pay for staying out of recession. I'm afraid it's probably higher rates for 5 and 10-year and 30-year bonds and higher deficits for the extended future, and that's concerning.
So, Robert, in 2, 3, 4, 5, 10 years, can you honestly make the case that some of these things will end up being deflationary or disinflationary? Will the infrastructure bill actually be deflationary? Will chips, will the IRA, which was called the Inflation Reduction Act? A lot of people laughed at that. But yeah. Do you think down the road, long term, you can make the case and connect the dots to this actually being deflationary or budget friendly?
If they improve productivity, then yes. In the near term, my own view is there's spiking demand for goods, services, and labor. I think one of the things I'm very aware of in the energy transition, who's the leader in the world? China. China is producing more electric vehicles than the United States. They're a leader in wind and solar. And so we've got a bit of deglobalization going on in chips, in the energy transition. These are very expensive transitions. Yeah. I mean, very expensive globally.
Isn't China also leading? It's also leading in coal. I mean, you got to power the grid. They don't care how they power it.
Well, so this is what worries me in the near term, and I've mentioned it before. This energy transition is going to take 20, 25 years. We're probably 5 years away, in my view, from peak oil demand. I know nobody wants to say that, but it's true. Yeah. And if we don't invest more in fossil fuel production in the United States, we will burn more coal globally. We'll have higher oil prices, and I think inflation will be stickier and rates will be higher.
You know, Bob,
and so that's something I would like to see, a more integrated energy transition.
You didn't say yes, it will be deflationary. You said if productivity improves.
Right.
So it's not a slam dunk. Do you think that productivity will improve and therefore it will be deflationary, or that you don't know?
Listen, I'm a business person, and so I know I've been involved in a lot of capital investments I thought would have one effect, and the world changed. And so I'm hopeful, and I know the theory behind these investments is they'll improve productivity, and I'm hopeful they will, and I think it's a reasonable theory. But on the other hand, there's a view that globalization and not doing everything ourselves, and I know some other economists have made speeches recently that if we limit globalization and the energy transition, it'll make it more expensive. And I'm very aware of that issue.